Good morning, everyone. You are watching a live daily market outlook for Friday, 11th of May 2012, prepared by Windsor Brokers. Overall, negative sentiment in the markets, pressed by uncertainty in the Eurozone, especially regarding Greece. That becomes a focus again after the last weekend's elections, and failure to create the new government keeps the pressure on the euro currency, as well as quite negative releases of the recent economic indicators that are showing a slowdown in the economic recovery in the world, basically. Keeps pressure also on the commodities, with the gold now looking for the heaviest weekly losses since March. The gold slipped basically to below 1580 after a quick recovery up to 16 zone, keeping the pressure the downside, and the possible test of our key supports at 1522, 1532, while single currency also is under pressure, as brief recovery seen yesterday was capped on approach to 130 zone, and currently is trading around that 3 months low around the 129 zone. The cable also is under pressure again after being capped below our next key barrier at 162.00, with the 161 now coming under threat, and the possible extension towards next supports 60.90 and 60.65, while dollar continues to appreciate against the Swiss franc, testing again 93 level. That will open way for a more significant gains and test of a very strong barrier at 93.30. More of this we will see on our technical part. Just to say that the highlight of the overnight session was news about losses of JP Morgan of around 2 billion euros, as the biggest a U.S. bank announced that it suffered a trading loss of at least 2 billion from a failed hedging strategy, with the shock disclosure that hit financial stocks and reputation of the bank and its CEO, Jamie Dimon. For a bank viewed as a strong risk manager that went through the financial crisis without reporting a loss, the errors are now embarrassing, especially given Diamond's public criticism of so-called Volcker rule that banned proprietary trading by big banks. The CEO said that this puts egg on our face, apologizing on a hastily called conference call with the stock analysis. He conceded the losses were linked to a Wall Street Journal report last month about a trader nicknamed the London Whale, who the report said amazed an outside position with the hedge funds bet against. Further news that came overnight, quite positive releases, quite negative releases from China, as industrial output came out. Output growth, came out in the weakest figure in nearly 3 years, with the Asian shares sliding after a release of Chinese data. From today's calendar that we are going to take a look now, as said, the Chinese CPI along with expectation at 3.4%. While PPI dipped to minus 0.7% compared to minus 0.5% forecast, and industrial production dipping from expected to 12.10% to just 9.3% compared to 11.9% of the month of March, as well as retail sales that dropped to 14.10%. Versus 15.10% forecast and 15.2% of the month of March. German final CPI for April came higher. It's revised. It came at 0.2 percent compared to 0.1% forecast and the previous release of March. This is on a monthly basis. Still to come today from UK, PPI input for April minus 0.9% negative forecast compared to 1.9% of the previous month, and the PPI output for April 0.4% is today's consensus versus 0.6 of the previous month. Unemployment rate in Canada is expected to go up to 7.3% compared to 7.2% of March, while employment change is expected to weaken with adding only 10.1 thousand of new jobs forecasted for today compared to the previous month, increased by 82.3% from US. April PPI is expected unchanged, while core PPI at 0.2% compared to 0.3%. The University of Michigan consumer sentiment for May is also expected to stay unchanged at 76.4. And we're going to take a look now on our technical part and see the latest movements in the markets regarding the major currencies and commodities. As said, the single currency maintains the negative tone and remains under pressure as the brief recovery attempt of yesterday's, 2 days ago low at 129.10 did not much on the upside. 129.78 was the highest level as 55 days exponential moving average capped the upside, and just ahead of 130.00 as our initial barrier on the upside. As long as I would say more significant and strong barrier at 130.60 highs of 7th of May, as well as 55% exponential 55-day exponential moving average, and the 38.2 Fibonacci retracement of the latest down leg from 130.82 to 129.04 keeps the upside capped. The focus is at the downside as studies on near-term outlook maintain a negative tone, and the loss of 129.00 that is currently under attack with 129.04 seen twice already. To turn focus to our next targets, 128.75 and 128.57. That might open way for a more significant extension lower, as just as a reminder, the pair recent losses broke below very significant support and the multi-month range floor at 130.00 and 129.50 zone. That's my open way now towards 128.75, 57 initially, and possible extension down to a main bull trend line drawn of 2010 low at 118.75 through 126.22 low of 2012 that currently stands at approximately 127.50 zone, and that will be seen as the next target in case of a break below 128.75, 57, and 128.00 as around figure support, with the possible short-term extension towards yearly low at 126.22 posted at the beginning of January, not ruled out at this point, as outlook for euro remains quite negative, and the pair is in the steady descent for exactly 1 year from 1st of May 2011 peak at 149.38. Sterling's quick recovery of 160.65 low of 9th of May, and yesterday's high low at 160.90 failed despite sharp gains and break above initial barriers at 161.55 and 161.70 zone. Failed to regain the next very significant barrier at 162.00. The recent congestion and the range top as the action stalled at 161.81 yesterday, and subsequent a quick reversal now, testing a 161 zone. This turns immediate risk at the downside with the 160.90 yesterday's low and 160.65 strong supports coming in focus. The second one is more significant, as this marks the break point of 160.80 higher platform and 160.61 previous peak of 2nd of February, pardon, 2nd of April, a break of which would open way for more significant losses and extension of the short-term corrective pullback from 163.00 peak of 30th of April 2012 and open 160.00 as 61.8% Fibonacci retracement of the upleg from 158.17 to 163.00, as well as as well as the main bull trend line of 152.33 through 156.00 and 158.17. that is currently standing at 160 zone. So we have quite a strong support at 160 area. In case of loss of current strong supports at 161, 160.80 and 160.60 to open way for a further correction of the longer term uptrend from 152.33 yearly low that peaked at 163.00 so far. On the upside, immediate resistance is at 161.81 that marks yesterday's high, ahead of a more significant 162.00, and basically only lift above 162 would avert immediate downside risk and turn focus towards 163.00. Until then, the focus remains at the downside, and the loss of 160.65, which is the low of 9th of May, also see a 50% retracement of the latest upleg from 158.17 to 163.00 to refocus 160.00 as a strong support and the next downside target. The dollar yen is in the near-term corrective mode, as shown on the hourly chart, after dipping to 79.42 on a brief break below our supports at 79.63 and 79.52. Brief break lower, found the ground so far at 79.42, but corrective action so far remains limited by 80.00, our initial barrier on the upside, and the subsequent weakness is now aiming lower. Studies on the hourly chart are losing traction and pointing lower, while negative tone persists on the 4-hour chart, with studies still holding below their midlines, as the upside remains capped by 55 days exponential moving average for now. A more significant barrier is seen at 80.60 high of 2nd of May and 3rd of May, as well as main bear trend line currently at 80.56, the bear trend line of 84.08 peak, and the only break above this level would avert immediate downside risk and turn the focus slightly higher. However, the overall picture on the dollar yen remains negative, as daily studies are firmly bearish, and the pairs break below 90 days moving average that is currently at 79.99, and while holding below this level, immediate focus remains at the downside. 79.13, 61.8% retracement of 76.00 to 84.17 and 79.00 are seen as the next targets on the downside, with the 200 days moving average currently at 78.42 expected to come in focus in case of further extension lower. As said, only break above the trend line and the static barrier at 80.60 would ease the current bear pressure, and open way for a test of a more significant barrier at 81.00 and the 81.77 peak of 20th and 25th of April. That will turn focus, regain of which would turn the focus higher and signal higher low at 79.42. Until then, the focus is still on the downside, with 80.00 still capping the immediate price action. The dollar Swiss continues to trend higher after brief corrective action seen off 2 days ago peak at 93.00 that was contained at 92.55 by 55 days exponential moving average on the hourly chart, with a fresh strength briefly breaking on the second attempt above 93.05 was seen so far. Still positive tone seen on the hourly chart with 4-hour studies in the positive territory, but quite extended, still seeing risk of corrective action, yet no any signal of correction. Daily structure is gaining now momentum. Studies are above their midlines, but RSI approaching the overbought zone that again might be signaling corrective action ahead of our key barrier at 93.30 peaks of 14 and 15th of March and 61.8% Fibonacci retracement of down move from yearly peak at 95.93 to 89.30 low of 2012 posted on 24th of February. On the downside, yesterday's low at 92.55 along with 92.69 previous peak offer initial support together with the 20 days exponential moving average, and ideally should contain the downside. However, further extension lower would not be that harmful for the pair as long as 92 zone holds the downside, where it's 55 days moving average and the weekly low at 91.94, and only break below these levels as well as 38.2 Fibonacci retracement, and as long as holding above these levels and any reversal above these points would keep the short-term bulls intact for a possible extension higher and test of our next key barrier at 93.30. Loss of 92 would turn the focus lower and mark temporary top ahead of deeper reversal with the 91.70 and the 91.40 Fibonacci levels seen on as the next targets in case of break lower. For now, the focus remains at the upside as positive near-term studies keep the focus higher. Crude oil, we're still in the June. Contract is still in the consolidative mode in past a couple of days after hitting fresh lows at 95.33 and the more recent one 95.18 9th of May low, with the sideways movements and the tone still skewed towards the downside as the upside remains capped at 98 zone, 98 98.17 peak was seen the highest of the corrective action, with the yesterday's upside rejection at 97.67 and the false break above 55 days moving average, keeping a focus at the downside. The oil price is, as said, correcting the current heavy losses of 106.40 that dipped at 95.18. And the negative tone that still persists on the lower time frames, as well as daily chart studies that are well below their midlines, and the current break below 200 days moving average seen on the daily chart keeps the downside still vulnerable of further losses, with 92.70 16th of December 2011 low seen as the next target on sustained break below the 200 days moving average, as several false breaks occurred during the past couple of days. Only regain of 167 levels would avert immediate downside risk and allow for some stronger recovery, but current negative tone sees the downside more favored. From the fundamental point of view, still fear of further reduction of demand for the energies keeps the pressure on the downside, as well as OPEC's yesterday's comments that they are at full capacity and that there is no any shortage of oil supply worldwide, sees that the problem is not in the production, but in the consumption of oil, and reduced demand regarding to the current crisis, deepening crisis in Europe is actually the main driver of the oil prices for now. And a quick look at gold. Negative tone dominates on the near-term studies, as the brief corrective action of 2 days ago low at 1579 was capped by 55 days exponential moving average at 16 zone. This also acts as a figure resistance ahead of fresh weakness that dipped below and hit so far 1572. That keeps the focus at the downside. The latest downleg from 1671 peak of 1st of May is now aiming towards very significant, very strong support. The initial one is at 1559, low of 15th of December 2012, ahead of a more significant double bottom at 1532, 1522, where the pair is going towards this level with the 1546 90 days moving average season as an interim support ahead of test of our key medium-term support 1522, 1532, lows of September and December 2011, and basically this will open. This would likely open way for a more significant correction of, as mentioned in our previous sessions, over 10 years, very strong rally from around $300 that peaked close to $2,000 per ounce. As the upside remains protected and the pair broke, the gold price broke below the larger picture triangle support. The only barriers now are seen at 1522, 1532, and the higher low of 26th of June 2011 at 1478, seen as the next target on break. The dollar Canadian remains well supported in its attempt to clear very strong barrier at 10050, where it's 200 days moving average, and the recent range top, as well as 38.2% retracement of the larger down move from 105.21 that bottomed at 97.98 at the end of April. A positive structure seen on the daily chart keeps the focus on the upside. With the break above this strong resistance zone required to open way for more significant gains, 101.00 and 101.60, 50% retracement seen next ahead of 102 and 102.45, 61.8%. Lower time frames are still holding a positive tone, as the corrective pullback of 2 days ago peak at 100.61 found the support at 99.75 on a brief break below the parity level, with the fresh strength now aiming towards 100.50, just holding around this area, as a brief break higher did not manage to sustain gains, and the extent higher 100.60 was seen so far. On the hourly chart, also the positive tone dominates and keeps the focus on the upside. Initial static support is figure support at parity at $1 ahead of 99.75, higher low of 10th of yesterday, with further down 99.21, higher low of 8th of May. On the upside, I set the break above 100.5060 to open 101 and 101.40. And finally, the Aussie dollar. Remains in the steep descent of the latest lower top at 104.73 of 27th of April, as a break of the consolidative range floor at 102.25 has seen extension towards parity level so far. 100.17 seen a negative tone on the daily chart, and the On the 4-hour chart, we see that the pair's recovery attempt of 9th of May low at 100.19 was capped at 101.42, and the subsequent fresh weakness and steep descent, now testing our previous low ahead of parity level and the possible extension lower, with the static supports at 98.80 zone seen on a break lower. Negative tone also seen on the near-term studies, with the hourly conditions quite stretched studies actually, and approaching the oversold zone might be signaling some corrective action. So far, no any signal of reversal, as the pair is attacking 100.17 ahead of a more significant parity level. That is our near-term focus. Thank you for attending our session. We are back on Monday at the same time at 7:00 GMT. For all those that connected later and missed any part, you can find the recorded version of this session in the YouTube Windsor Brokers page. It's called the Windsor Brokers Forex. Along with this, you have a number of brief technical analysis reports. I wish you a nice day and a nice and relaxing weekend. Good luck.